Hi, we are Group F, and this is our BSG presentation. I'm Makena Blanco.
I'm Simran Kaur.
I'm Mary Hicks.
I'm Jennifer Perez.
And I'm Elena Mirabito.
Our group name is In Action. Okay, so our strategic vision is to be the worldwide low-cost leader in athletic footwear. We strive to lead the market of fairly priced shoes while maintaining good quality of our product and our company. In year 11, you can see that we dominated the lower left quadrant of market share. We did this by focusing on cost and efficiency with fewer models, understanding our customer base across the globe, investing in multiple manufacturing facilities, expanding business in Asia Pacific, and partnering with celebrity Bronco Mars. In year 14, we continue to focus on low-cost worldwide manufacturing and distribution. We kept the number of models sold to a minimum to continue to keep costs low. We also kept our partnership with celebrity Bronco Mars, who maintained high ratings in the Asia Pacific territory. Now diving into net revenues. On the right-hand side of the slide, you can see our net revenues broken out by product category, including wholesale, private label, and internet. We have maintained steady growth across all three from years 11 through 14. Looking at the graphs, you can see that private label revenue is tracking at the highest contributor to net revenues, followed by internet and wholesale. It is also worth noting that internet revenues have shown significant growth with an increase of roughly $120,000 of upward movement through year 14. When looking at our net revenues, we can see that our competitive strategy to maintain low cost has been successful. We have been able to defend against potential competitors by holding firm on our strategy. We've also been able to focus on specific markets where we thought a low-cost strategy would excel the most. Additionally, we've invested in production facilities in Latin America to support growth in that market. To uphold our low prices, we decided to limit the superior materials used in production. We wanted to use enough to produce good quality products without exceeding our low-cost budget. And we've been able to sell at a high volume and capture a big portion of the market share by keeping our production costs low and allocating funds towards marketing.
So switching gears to earnings per share, when our management team took over In Action, earnings per share was sitting right at $2 per share. We saw a tiny immaterial drop in year 11 and then increasing in earnings per share in every year since, which has indicated the growth in our company's profitability that we're striving to maintain and continue to grow year over year in the coming years. Our competitive strategy for earnings per share and continuing that growth trajectory, we have focused on maximizing our profit and reducing the total number of shares outstanding whenever possible, which has not been every year, but that's been our overall goal and strategy to maximize earnings per share. We focused on our lower cost production and strategic investments in assets, which would increase our production capabilities. So really what we've been focused on is driving the maximum amount of production that we can afford so that we can sell a lot of shoes, a high volume of shoes at a reasonable price and maximize profitability and earnings per share that way. We invested heavily in internet advertising, brand advertising, in mail-in rebates, and certain celebrity endorsements to increase our sales and our operating profits, especially over the volume and the amount of shoes that we've been producing at a low price. We also strategically invested early in best practice training and total quality management and Six Sigma programs during the first years of our management of this company to really employ and exploit that learning curve for long-term cost savings. So we've spent more in the early years to make sure that our best practices and our employees set us up for continued earnings per share growth in future years. Our company started year 11 with 20,000 shares outstanding, and we've strategically repurchased shares in years 11, 12, and 14 to reduce the number of shares outstanding for our company. We did issue about 12,000 shares of common stock in year 13 because we were investing heavily in production assets to increase the number of shoes that we could sell and produce. On our stock price, you can see that we've seen growth in years. We had a really high growth between years 12 and years 13, which is really when our production and our low cost model started to take off. Our credit rating and image rating have really improved over time, which has helped increase our stock price. We have been focused on paying down debt to improve our credit rating and targeting market share to help improve our image rating. Our competitive strategy with regards to stock price, we focused heavily on financial performance measures, and we're one of the few companies to pay dividends every single year. Our financial performance factors included revenue growth, strong earnings, and healthy profit margins. To help drive these factors, in action did the following activities in the first few years of our management of the company. In year 12, North America private label operations earned a negative margin over direct costs of $1.24, so we lost money there. Controlling costs really helped us increase market share and transformed the unprofitable North American private label operation in year 13 to a $10.49 margin over direct costs. So we've really been able to turn that market around. In years 11 and 12, Inaction increased our dividends 5 cents yearly. We held dividends steady in the years since at $1.10, and we plan to continue to increase dividends each year as the company matures and our investments in assets and production help the company grow and mature. In year 13, our stock price rose by $52.89 per share, which we were really excited about. North America saw significantly improved profitability in year 13 over year 12 in both the wholesale division, the private label, and our internet sales. Our company image rating rose 6 points, and our total revenues in North America rose by 27% year over year, which really helped with our stock price and was part of our strategy in improving stock price there.
In order to assess the success of our strategy, Inaction undertook completing a competitor analysis on another team playing the game. For this analysis, we chose Group F. For this game, our Group F, employed a low-cost provider strategy. That is why we identified Group G, because they also attempted to capture low-cost market share in a similar fashion to us. After reviewing our weekly statistics against their statistics, our finding led us to conclude that the way we went about making each decision held up better than theirs, and we found that they were not as effective a competitor as we were. Some things that led us to this conclusion were that they failed to produce each pair of shoes at as low a cost as we did. This caused Group G to be less profitable than us. Also, our lower production costs allowed us to offer shoes at a lower price than Group G, ultimately leading us to capturing more of the market share. Although Group G had a high SQ rating, more companies chose our shoes, leading their brand reputation to falter. And from our assessment, their gains were mainly due to our stockouts, meaning if we were to produce more shoes, they would not be able to compete with us at all. Further proof that we are a better competitor comes from analyzing our stock prices. Our stock prices soared in this game, while Group G has not made any major moves. We have also taken care of our shareholders by issuing dividends in every year, where Group G has not issued any dividends. For all of these reasons, though Group G is employing the same type of strategy, we, Group F, have deployed the strategy much more effectively. Forensic checklist. For this part of the forensic checklist, we will focus on EPS. Earlier in this presentation, we spoke of our EPS. Now we will define it more clearly and discuss the important drivers for our EPS at this stage of the game. EPS, or earnings per share, is a financial metric calculated by dividing a company's net income by the total number of shares of stock issued to its stockholders. A higher EPS value signifies that the company is generating greater net income per share of stock outstanding. The drivers for EPS are directly determined by the company's net income, total number of shares of stock issued to its stockholders, and the factors that can influence EPS include improving profitability through cost-cutting measures or increasing revenue to increase net income, reducing the number of shares outstanding through share buybacks, or not issuing new shares. The most important driver for our team right now are controlling and increasing sales and market share. For this part of the forensic checklist, we will focus on ROE and what is the important drivers of ROE are for our team in this stage of the game. ROE, or return on equity, is a financial metric that is calculated by dividing a company's net income by the average amount of shareholders' equity investment. The average amount of shareholders' equity investment is computed by adding the shareholders' equity at the beginning of the year to the shareholders' equity at the end of the year and dividing the sum by 2. Drivers for return on equity are net income and average amount of shareholders' equity investment. Factors that can influence return on equity determinants include increasing net income through cost-cutting measures, increasing revenue or improving profitability, increasing shareholders' investment through share issuance or retained earnings, reducing shareholders' equity investment through share buyback or dividend payments, changes in interest rates, tax laws, and economic conditions that can impact a company's financial performance and equity valuation. The most important drivers for our team right now are controlling costs, increasing sales market share, reducing number of shares outstanding, and increasing dividend payments.
In this slide, I will be discussing the forensic checklist for a stock price. A stock price is the existing cost of a single share of a company's stock that is accessible for purchase or sale in the stock market. The value of the stock may fluctuate based on several factors, including the company's financial performance, general economic conditions, and the demand and supply of the stock in the market. The drivers of the stock price are primarily influenced by the interplay of supply and demand among buyers and sellers on the exchange. Additionally, several factors can affect the determinants of stock price, such as the company's financial performance, market trends, industry competition, macroeconomic conditions, government policies, regulation, taxes, technological advancements, and corporate actions. Currently, our team is focusing on implementing corporate actions like initiating stock buybacks and increasing dividends as the most significant drivers for our stock price. Next, I will be discussing the forensic checklist for credit rating. A credit rating assesses an individual's or companies or a government's reliability in paying back borrowed money. Typically, credit ratings are provided by rating agencies, which help lenders and investors to decide whether or not to lend money to the entity. Credit ratings can range from positive to negative and can affect the interest rates charged on loans and other financial products. The drivers of credit rating are primarily determined by the entity's credit history, including their past record of repaying debt on time and in full, as well as their current financial situation, such as their income, assets, and liabilities. Additionally, several factors that can influence the determinants of credit rating include payment history, amounts owed, length of credit history, credit utilization, recent credit inquiries, economic conditions, regulatory changes that may impact the entity's ability to repay debt. Currently, our team is focused on reducing outstanding debt while continuing to invest in assets that increase performance and market share as the most important drivers for our credit ratings. Next, I will be discussing the forensic checklist for image rating. And an image rating measures a company's overall reputation or perception in the market. This measure is calculated by considering factors such as branded SQ ratings, market share, and corporate social responsibility initiatives. The image rating is likely used to assess how consumers, investors, and other stakeholders view the company and may influence decisions related to investments, brand partnerships, and other business opportunities. Regarding the drivers of image rating, it is primarily determined by the company's brand recognition and reputation in each geographic region, as well as its global market share for both branded and private label products and efforts in corporate social responsibility and citizenship over the past few years. Additionally, several factors can influence the determinants of image rating, including the quality and perceived value of the company's products and services, marketing and advertising efforts, customer service and satisfaction levels, reputation for ethical and responsible business practices, environmental and social impact, and financial performance and stability. Currently, our team is focused on maintaining celebrity endorsements and continuing to generate positive stock returns as the most important drivers for our image rating at the moment.
Okay, our 3-year competitive strategy. Another strategic rival that we have identified is Group H. We have noticed a pivot in them in year 14. So our strategy to outcompete. First and foremost, we want to increase our credit rating by paying down debt and driving our profitability. We have not been shy about taking on additional debt to help us, and we do that as an alternative to issuing stock. And additionally, we would like to increase our earnings per share by increasing our volume sold and controlling cost. We increase our volume sold by investing in our production capabilities and investing in marketing, and we control costs by making sure that our model brands or our model number is down, and that our SQ rating, our percentage of superior materials to standard materials is kept stable. We are planning to increase our return on equity by paying down debt, as we mentioned before, to increase our equitable positions. And then we are wanting to increase our image rating by improving our market share, displaying positive corporate citizenship, and of course, maintaining our SQ rating, as I mentioned earlier. Lessons that we have learned. A low-cost provider strategy is very difficult to execute. This strategy in general is a little riskier than having a high or average price shoes because we are pushing volume of our products to gain market share and make up for that lower profit margin. We are issuing dividends to help increase our stock values. And as mentioned previously in our presentation, we are one of the only groups to be issuing dividends. And we recognize the importance of taking loans early on in order to increase production and marketing ability. Like I said before, we have not been shy about taking on additional loans to help us. And also we have learned that product pricing is an important part of the long-term strategy. We have maintained stable prices for the most part, only increasing by $5 or so here and there, rarely anything, and we've continuously outpriced our competitors. We've also learned that it is a struggle to balance the cost of production versus the SQ rating that the products receive. This is something that we have sacrificed time and time again throughout the years, is our SQ rating in order to maintain that high level of production for that volume that we need to push to achieve our strategy. And then bidding competitively on a celebrity that is highly rated in our target market is also a key part of the marketing budget. We do set a spending cap every year to bid on the celebrities, and we've maintained celebrity relationships with Bronco Mars specifically to help us in our areas that we are pushing our product the most.